And we're live.
Hey guys, welcome to the Apartment Educators webinar. We've got a really exciting webinar teed up for you guys today. We're going to give it a minute for some folks to jump on and join, and then we're going to get some of our live feeds and whatnot set up. But we've got a really exciting topic for you guys today. We're going to talk about really one of the core fundamental reasons we invest in multifamily, and that's the ability to proactively influence the value of an asset in a way that we just can't do if we're flipping houses or if we have rental real estate or all these other real estate investing avenues and mechanisms that we have. Multifamily is kind of unique next to some of those other asset types like single family or flips or rentals, in that we can it's called forcing appreciation, right? We can proactively do things to make the value higher. So we're going to talk about how we turn $1 into 16, and we're going to walk through some of those elements there. So we're going to get the presentation up here on the screen in just a moment, and we'll dive right in. We're also giving it just one more minute here as folks kind of jump in, maybe on your lunch break or your work from home break or whatever you are working on. Hopefully you're getting back to work, as we're seeing a lot of Texans do right now. So we'll have the presentation come up here in just a moment, and then we will kick it off for you guys. So welcome to today's presentation. This is how to turn $1 into 16 using apartment investing. That's a pretty big transformation there of one little dollar. And so we're gonna break that down for you guys. The vision for this meetup, I'll turn this over to my co-host Abel to jump in and kind of talk about the vision.
Hi everyone, Abel Pacheco, nice to see you guys. The purpose for our meetup is really an opportunity to get everyone that is interested in learning more about apartment complex investing, multifamily investing, whether you're an active member or a passive member in the deals. We're really providing some education was one. And then the second, really big component to these meetups is a networking opportunity. So having the ability to meet with other like investors that either want to go do deals, are interested in learning more, you're trying to figure out who your team is. This is a great venue and platform to do this. So we're actually in San Antonio, Texas. It's where we do the most of our investing here locally. And it is a great opportunity for us to kind of come together. I know while things are closed down, it's a different atmosphere on the internet, but we wanted to continue the forward progress. We've been meeting for about a year. I've had a pretty good solid following here in San Antonio, Texas. So, right now we're meeting on these webinars, live webinars twice a month. So bi-weekly, we try to do a lunch and then also an evening. So we look forward to having you guys. And that's really the purpose for our meetup. And thank you guys for joining. Appreciate it.
A little bit about today's sponsor, Apartment Educators. What we do is we teach people how to invest in apartment complexes, right? And so this is an entire ecosystem of education, tools, resources, the network to plug into to go out and buy apartment complexes. And this is anything from 10 units up to 300 units, right? It's kind of the same mechanism, but the mechanics of it are fairly straightforward, but obviously there's a lot of pieces there that need to happen. And a lot of it's kind of the network and the connections to be able to make that happen. So that's why we built apartmenteducators.com. This is a photo here with some of our coaching students. And we have, occasionally we'll bring on a handful of students, and we are accepting applications right now. If that's something you want to explore, you can go to apartmenteducators.com to check that out.
If I can, on the apartment educator side, if you guys are trying to figure out whether to invest passively or actively and trying to get some more education, is an amazing opportunity. I'm a big fan of it. Mentorship, coaching, guidance. This is an ideal platform if you guys are interested in also learning how to go do your own deals, raise capital, bring funds. So I'm a coach with the company, excited to do that. But When you're here, whether we meet in person or on the internet, let us know if you want some referrals, individuals to talk to, just to get some guidance and experience from them. Let us know. Happy to help you, and excited to have you.
So the agenda for this meeting, we'll do an introduction, a little further introduction of Abel and I. We're going to talk about why multifamily investing versus other investment options. We're going to talk specifically about turning a dollar into 16 and covering the business plan. And then one of our favorite parts is Q&A at the end. So on that note, there's a question and answer box at the bottom of your screen. If you have questions at any time throughout the presentation, just go ahead and start typing them in now or as they occur to you. And then at the end, we'll get to everybody's questions. And again, that's kind of an interactive, fun part for us. So please, throughout the presentation, if you have questions, just start typing them in the box right there. A little bit about us. My name is Devin Elder. I was born and raised in San Antonio. I'm the principal of DJE Texas Management Group. We are an investment firm with close to 2,000 doors now and over $130 million in assets that we've been able to build up over close to the last decade. I am here, despite all our assets and everything. I'm here because doing deals in multifamily is about the team and about partnerships, right? So we want to partner with folks and go do deals. I want to invest passively with people. I want investors to passively invest in my deals. And all that stuff kind of starts with networking. So that's why I come to do these things, because there's a high likelihood that somebody watching right now will develop a relationship at some point, get a deal done, and everybody makes money. So one of the benefits of multifamily investing is that the pie is pretty big, and we can support a lot of people winning in one deal. And once you do that, you want to go do more. And that's where I'm at, is wanting to do more of that stuff.
And my name is Abel Pacheco. I'm the president of 5 Talents Commercial Real Estate. So we're born and raised in Corpus Christi, Texas. That's where I'm from. I spent 20 years until the last 20 in San Antonio. So Texas boy. And we are invested in about $60 million worth of multifamily commercial real estate today. So myself and my wife, and have been real estate investing since 2008. So I was in the corporate world for a good number of years, had a nice 10X run where we took a $5 million run rate a year business and turned it into a $56 million run rate worth of business in about 6 years. And the reason that I'm here is because I have been able to obtain a lot of education, a lot of good mentorship and guidance. You'll hear me say this again and again because I'm a product of somebody else's help. And so people helped me get to a position where I'm able to go do these deals. And essentially, I love giving back. I love serving others. All of the things that Devin mentioned absolutely reign true in commercial real estate, which is you have the opportunity to partner together, to learn together, to work together. And chances are pretty good that somebody in the group is either going to be an investor or a partner in the future. And I love to go, build great teams to go do more deals. And, this is a great opportunity for all of us to come together and just kind of meet other like-minded investors. So nice to meet everyone, and look forward to hopefully shaking hands sometimes in the near future once we all kind of come back together here. So thank you guys.
So real briefly on why multifamily. There's a lot of reasons we like this asset class, but number one is the returns. And this is via cash flow, which is monthly or quarterly distributions that are going out, plus equity that we're creating in these projects. And we're going to delve into that more, but we do get the cash flow. That's spendable cash that we get on a monthly or quarterly basis. And then we also creating equity on the back end that we'll realize someday through a refinance or sale. So those things are very attractive. This can be a passive or active investment. So, for example, my firm, DJE, we are active, right? I mean, we're the ones running these properties. We're running the business day to day, and that's our day job. So it's very active. But we have a corresponding amount of equity. We're doing all the work, and we've got a lot of equity in these projects. We've also got passive investors that do nothing on a day-to-day basis at all. They just have their money at work. That's a very pure way to participate. And I'm a passive investor in multifamily deals as well. You're also getting tax benefits. So we're seeing tax benefits available in multifamily that just don't exist in a lot of other investment vehicles, right? And it's also a safe asset, finally, here, that we are investing in a physical thing here. It's dirt, it's a building, it's residence and an income stream. So it's a real tangible asset versus some of the more ephemeral things that we have an opportunity to invest in. This is a real thing, a real business, and a fundamental business, right? I mean, this is not a nice to have. Roof over your head is a must have. And so we like that aspect of it.
And from a multifamily standpoint, if anybody is listening literally on their lunch break, don't be discouraged because you have a W-2, a full-time job. I had a full-time job from 2008 up until last year, and I was able to invest really in real estate with my active W-2 income. The real estate creates an amazing tax benefit. Specifically multifamily, we were able to get into 800 doors. Devin mentioned passive investor. I'm a passive investor in about 400 doors, 2 deals, and an active investor in another 400 doors-ish in another 2 deals. And this was all while I'm working full-time. So for some of you that have maybe these dreams of becoming the real estate investor full-time, how to get into that and replace your W-2 income, I would say a very risk-free way to jump in is to maintain and keep your day job, keep your W-2, especially if you're a high W-2 earner, and you can invest passively through the deals. That's just one of the best parts about multifamily investing. And Devin mentioned that a team aspect that's what we're building. We're building an opportunity for others to invest alongside a lot of expertise and experience.
So let's dive into kind of the meat of the content. How do we turn a dollar into 16? And we're going to focus on something called net operating income. And the way that that's calculated is you have a series of operating income line items, right, on a P&L or a profit and loss statement for a business, right? So what is all your income on an apartment building on this business? Well, rent is the biggest one, right? Rent's collected. You might have some other income if there's parking fee revenue or laundry income or late fees or kind of all these other little pipsqueak line items. But the majority, the big dog is rent, right? So you've got your rental income. You've got some other income line items coming in on a monthly basis. This is recurring, right? So you've got that coming in. And then you've got your expenses for what it takes to run the property. These are your operating expenses. So these are things like payroll, taxes, insurance, contract services, whatever it takes to run the property on a day-to-day basis, right? Just like any business has operating expenses. So you have operating income and then you have operating expenses or OPEX. So you take your operating income, all the money you collected, let's say you collected $100,000 for the month, right? You got 100 units, they're paying $1,000 in rent. Just to oversimplify it, everybody pays, you got $100,000 of income. And let's say you got $50,000 of expenses that month for staff, for taxes, insurance, pay for your website, all that good stuff, right? So you got 100,000 operating income, $50,000 operating expenses. Easy math, you got $50,000 of net operating income. Now, out of that net operating income, you're going to have to pay the mortgage, but we don't include the mortgage in the net operating income because mortgages are going to vary. Interest rates are going to vary, terms are going to vary, and some people own these assets cash. So net operating income gives us a pure metric to value these apartment complexes without worrying about what kind of loan we have on, right? So it's a very pure metric. So you might hear somebody refer to above the line or below the line. The line is net operating income. Below the line means you're taking it out after net operating income is calculated. And that's, we take the mortgage payment out below the line. So you might hear that in multifamily above and below the line. So what we have with the net operating income is the ability to value the property. And at a very simple way to evaluate a property is take the net operating income and divide it by a cap rate. So in this first bullet point here, we have this formula. it says $1 divided by 0.06 equals 16. And that's a simple math calculation. 1 divided by 0.06 equals 16.6 repeating, right? So that's kind of the number we're going to talk about. And this is $1 turning into 16. So we talked about what net operating income is, and we define net operating income. You have your operating income minus your operating expenses, 100K minus 50K equals 50K of net operating income. So what we want to do as investors is to improve that net operating income. So in this example, we're talking about improving our net operating income by $1. What happens when we improve our net operating income by a single dollar? This could be through increased income. Maybe we get $1 more in rent, or maybe we reduce our expenses by $1, right? Either of those things is going to impact net operating income the same, whether we cut expenses $1, whether we raise income $1. Or maybe we raise income 50 cents, we cut expenses 50 cents. The net for the net operating income is $1. So what happens to that additional dollar of net operating income once we've got that on the property? Well, what does that do to the valuation? And this is kind of the crux of what we're getting to. A property is valued simply by net operating income divided by a cap rate. And we'll talk about what the cap rate is here real quickly, because it's kind of an esoteric formula to the uninitiated here. But in this example, we're saying that it's a cap rate of 6, right? And so what we want to do is, and you know, I actually realized an error in my math here. It's 0.06, right? 6%, right? So it's not 0.6, but it's 0.06, right? So just want to clarify that to anybody that's catching my math here, is that you've got $1 divided by a cap rate of, let's say 6%, that's gonna be 0.06, right? So for the cap rate is essentially what the marketplace is saying about things that are selling, right? So the cap rate is a little bit out of our control. It's kind of based on a whole myriad of economic inputs, right? What does population growth look like? How desirable is the asset class? I mean, there's so many things that happen to determine a cap rate, but you can basically look at an area, say San Antonio, and determine kind of a prevailing cap rate. So the cap rate definition is, what is this property going to return as an investment if you owned it all cash? So a 6 cap rate says that if you just own this thing outright, you're looking at a 6% annualized return. And that's one way to look at what a cap rate is, right? So net operating income divided by cap rate equals value at a high level, right? So if we've got $1 of increased net operating income and we divide it by 0.06, and we get that $16, right? So every dollar you can improve net operating income in this 6 cap rate example is gonna be a $16 translation on the valuation. Now, what do you do with that $16 after you create that value? You can either refinance, well, you can do 3 things. You can sit on it and leave it and do nothing. You can refinance it and pull out your money tax-free. When you refinance, you pull out $1 million out of an apartment complex and give it to your partners and investors. That's not a taxable event, right? It's just a refinance. It's incredible. So you can leave it, you can refinance it, or you can sell it. And that's when you realize all your equity and potentially pay your taxes there at the end. But that is really the magic of multifamily here, is that we are finding ways to, how can we improve net operating income by $1, divide it by a cap rate of 6 or 7 or 5 or whatever it is. It's still going to be a huge number in valuation. So you could, give you a silly example, but let's say we're able to charge $20 for parking on 90 parking spots. That's $1,800 a month times 12. That's $21,600 a year by charging $20 for a parking spot, right? Well, if we divide that by a 6 cap rate, 0.06, that's $360,000 in value. I mean, that's real money, right? If we've got 90 parking spaces, we can charge $20 a month for covered parking. Divided by the 6 cap rate, you're creating $360,000 in value. So that's really kind of one of the incredible things about multifamily is that we're increasing the value by doing small things. In that same example, I also could have reduced expenses by that same amount. And it's going to have the same effect on your bottom line, whether you reduce expenses or you raise income. Ideally, you're working on ways to do both, right? So that is the kind of magic of multifamily here and how we're creating NOI, turning that into value. Abel?
Yeah, before you move on to the next slide, because we have some pretty good examples, right? I want to make sure that, you know, people understand that part of cap rate and kind of what you were explaining as the crux of the increase of value. So we're using a 6 cap because it's a good example for a San Antonio, Texas, capital rate on it's actually a capitalization rate. Cap rate is for short. It's the ratio of, that net operating income over the asset value, right? So to give you a couple of examples before we show you the real example to increase it, if a cap rate was 10% and a property was $1 million, well, then that means the NOI is basically that the $100,000, right? So property is $1 million, cap rate's 10%, you get a 10% return on $1 million, and that's $100K of NOI. So if I was a cash investor and I had $1 million cash and I bought that property for $1 million at a 10 cap, then I know that I would get 10% of my money every single year, and I would be able to essentially pay off the property in a 10-year period. So it's not a 10 cap in San Antonio, and not unless that deal has a little more risk, would it be a 10 cap. But essentially that's always the struggle between the value of the property, how much NOI is being created, and what's my capitalization rate. So when Devin says the cap rate is created with all of the different market influences, if I literally had $1 million of cash, then I could say, well, I could invest it in stock, I could invest it in a bond, or probably wouldn't want to do that right now, but I could invest it in multiple different investments, and I would be measuring the return if it's 8, 9, 10, 11, if it's 6, as the 6 cap, I would say I put my $1 million in and I'm expected to get a return of at least 6%. So the number is not, it's not really pulled out of nowhere. And Devin says, man, it's hard to explain because the going rate, this is kind of where people feel comfortable or the deal's being traded at the 6 cap in a San Antonio, Texas. In a California market, it may be lower, especially right now, it could be 4 or, a much lower percentage rate. In another market, it could be 8. So whatever your cap rate is in your market, that's really what you're going to plug in. And so, man, going back to the examples, there's a great slide, I think that shows this lead up, Devin, to the next slide where you have some really great examples on what can you do to turn a buck into 16.
Yeah, so that's kind of the overview of the math, what a cap rate is, how we improve net operating income. So again, I alluded to it. There's 2 ways you can increase income or decrease expenses. So we'll talk about some of the high-level ways to increase income on a property. The first and kind of most obvious is to increase rent. So if you have a property at $800 rent, right? $800 rent for a unit. But the unit is old, it hasn't been updated, it's got a dated look to it. Maybe it has some issues in terms of plumbing not working or things like that, right? We can go in and do a pretty straightforward, what we call value add. And they kind of, it's not rocket science, it's a pretty straightforward upgrade, but we go in and put vinyl plank flooring, 2-tone paint, fixtures, maybe spruce up the cabinets, maybe go from white appliances to black appliances, some things like that. And that has, if you go in and you impact everything your eye sees in an apartment and you update all of it, it looks pretty good, right? And it's relatively inexpensive to do that. And now instead of an $800 rent, maybe we're getting a $900 a month rent for that upgraded unit, right? So we've increased rent by about $100 a month. That's $1,200 a year. So let's take that 1,200 of increased net operating income, right? Because the apartment costs the same to operate at $800 a unit versus $900 a unit in rent, $900 a month. So you get $1,200 of value add income per year divided by that 0.06 cap rate is $20,000 in valuation improvement, right? So pretty powerful. So increasing rent is an obvious one. We want to see, hey, on a property, how many units have not been renovated? How many units can we renovate? Sometimes there's even a property that, hey, they've renovated 20 units and we can already see the rents that they're getting. And our other ones, we can move up to that level. So the big elephant in the room is, can you move the rental rate up by doing some improvements? Or in some cases, just taking it up to the market rate. Maybe the previous owner didn't mess with that, or they didn't keep up with the market rents. And sometimes it's as easy as just moving to market rents. Some other ideas to increase income: you might have reserved parking or covered parking that isn't being charged for. You might add some laundry services on site that will be a little bit of ancillary income. You might have a valet trash service where people can leave trash outside their door and come pick it up for a nominal fee. But think about it, a nominal fee to one resident can be powerful. If you've got a 200 unit apartment complex and you've got a $15 a month fee, convenience fee for somebody, that's $3,000 a month. You know, that turns into $36,000 in revenue a year, divided by a 6 cap is $600,000 in value. So it's not too difficult to connect the dots from a resident paying $15 a month for a service to $600,000 in value. Now, this math is definitely simplified, but that's the truth of the matter. You know, a resident is not going to think much about $15 a month on their bill for something that adds value, and they don't have to walk down to the dumpster in their flip-flops or put the trash can on their car. I remember doing that when I lived in apartments. You know, you put the trash on the hood, drive it down, throw it in the dumpster. You know, I probably would have paid $15 a month to have someone just leave it outside my door. Well, if 200 residents are doing that $15 a month, you're looking at over $500,000 in value creation. I mean, that's why we're doing apartments. Really, I mean, at the heart of it, that's what we're doing here. Private yard. This might be taking some grass area off the back of somebody's sliding glass door and just boxing it in. You know, a couple of posts go in the concrete. You put up some wood. You know, you spend a little bit of money doing that for somebody, and now they've got a private yard where their pet can run or their kid can run outside and not run off. You know, and that's a huge value that's relatively easy to implement, right? Tech package might be another one where you've got Nest thermostats, or you've got some Bluetooth enabled locks or things like that people like, and they're willing to pay a small nominal fee. Remember the ROI formula, right? We want to look at, if we're thinking about investing in some sort of upgrade, we want to figure out what our ROI is. So if we can get $100 annual income off of something, let's just use rent because this is the most obvious example. If that $800 a month unit can rent for $900, we've got $100 a month improvement in our income. Annualized, that's $1,200 a month improvement. So we want to understand, what is the annual income divided by what did it cost us to get that? Well, in this example, let's say we go in to renovate a unit, it costs $4,000. Flooring, paint, fixtures, lights, etc. It costs $4,000 to go in and do all that one time, right? And we expect to capture $1,200 per month increased revenue. So we got $1,200 a year, divided by the $4,000 investment we initially put in. That's a 30% ROI on that $4,000. It takes about 3 years, a little bit more than 3 years to pay off that investment. So that's kind of the filter we look through when we're deciding, hey, do we go in and spend the money on private yards or this tech package or this or that? Well, what's the ROI? What annual income is going to generate for us, and what divided by what it cost us? And we're looking for stuff that's 20% or better annualized ROI. So that's the income side of how we improve net operating income. And there's a laundry list of other things to do, but these are some of the obvious ones. Abel, I don't know if you want to add anything to that.
Yeah, so thank you, Devin. So you gave us a great breakdown of all the different plays, strategies, your tactics to really increase value, right? So when you're an apartment investor, you're trying to take a buck and make it 16. So when you're evaluating the properties, how do you actually know that you can pull this increase off? Like, how do you know that? And I think that's where, once you start looking at more of these investments, you can pull a CoStar report, you can talk to your property manager, you can look at apartments.com, you can walk or drive by or go into and talk to some of the comparable apartments in the area. And when Devin says, well, if my market rents are 800 and my plan is to bump them up to 900, how do you know you can actually pull that off? And that's looking at your comps. That's spending time in your market or submarket. You're looking at the data and the analytics for the residents. What is their demographic? What's their median income? How much discretionary fund do they have available to them? All of those things are the data points you're looking at, and more. But you're looking at those data points to say, okay, if I did this increase, does the math work? Yes, I can increase every unit, 100 of them at $4,000 a piece. That's $400,000 increase. Can I get that return off that money? And if the answer is yes, based on your comps, then it's a pretty great plan. It's a private yard, great plan. Tech package, great plan. Those tech package may not work in a C, minus, rough neighborhood, but it sure would, it potentially will kick off in a, B plus or definitely an A, so those are the things that, an experienced, team should be looking at, will be looking at to figure out, yes, that's the play. How do I know I can pull it off? And, those are all the increased plays. So on the flip side, Devin mentioned decrease expenses, right? So, and there's another play completely that has nothing to do with you investing in improvements, capital improvements, or spending any money. It's really on the decrease expenses side. So, Devin, you've got a lot of expertise. You're on a roll, baby. Why don't you keep going?
Yeah. So look, you've got two ways to boost net operating income. You boost income, you decrease expenses. So we talked about how to boost income. Let's talk about how to decrease expenses. Utilities is an interesting one. I put this first because we bought a property a few years ago. And I don't have the numbers in front of me, but it was like $200,000 a year in utilities that the property was paying, right? So when we were buying it, I'm looking at it going, well, why is the property paying this? The property's not using these utilities. The residents are using the utilities. They're consuming it. But it was kind of this all bills paid type of model, right? Which is kind of has a negative stigma, an all bills paid property. You just kind of go, geez, I don't know if that's a very high quality type of environment, right? So looking at this property, $200,000 a year property is paying. Well, that's a lot. So what we did on that property through whole program and upgrades and all this, but we basically took that expense and moved it over to where, hey, the residents are paying their utilities. And that also creates less utility usage, right? If somebody knows that they're not paying the water bill and they let the sink run for an hour, who cares, right? But if they are paying that bill, they're going to be a better steward of that resource, right? Whether it's water or electricity. So there's an argument there on kind of a bigger macro environmental scale that this is a better thing, that people are watching their resource usage, right? But it also improves the financial performance of the property, right? So utilities is one that you may be able to either reduce, and there's different things you can do with low flow toilets or LED lighting or things like that are going to just reduce overall the usage of the property, or you can shift the expense from the property itself to the residents to the actual usage. So that's a big one, right? To decrease expenses. The next one I'll talk about is the debt terms. I mean, this has a huge impact. If you've got an interest rate on a property at 3.5% versus 5%, and you've got a $5 million loan, I mean, if 1.5% on a $5 million loan is $75,000 a year, right? So you're talking about over $6,200 a month in interest expense if that interest rate swings a little bit, right? So depending on what the market's doing with interest rates or the terms, that's going to have a huge impact on your financial performance of the property. We might also have something called an interest-only period where you're not paying the principal down over time. You're just making the interest payment. Now, that's not lowering your principal, which that's not great, but you're also not having to come out of pocket every month to pay that down. And so that can improve your your net operating income, at least in the first couple of years of the property ownership where you might be doing a turnaround. Abel?
Hey, before you go to these two, those are some big ones. So we'll dive a little deeper into both of these. The utilities play, the example that you have, $200,000 of expenses that the apartment building was paying. You shifted that over to the renters, and I'm not sure if there was a cost that you paid to have the individual meters and that type of thing, but what was the actual, like at the very end, what was the total amount that you shifted over to the renters? Was it 100%? Was it 50%? Was it a portion of it?
Yeah, it was probably 90%.
Okay, so not if it's $200,000, I think this example is awesome to hear. 90% of that is $180K of NOI. So you're not raising rents. We didn't increase anything from renters. What we did tell them is, I would imagine through this, hey, we're going to go easier on rents and we're going to shift some of this expense over to you. So, but at $180,000 of net operating income at a 6 cap, that was a $3 million increase in that property. Is that correct?
That's right. Yep.
So that's the play. That's the play is how to invest your money as an investor and create the best possible return. And for somebody like, if anybody's watching that's kind of like me, I wanted to learn how to do this. I wanted to learn how to engage and how to go create, but I've never done it myself up until now. But prior, I wanted to invest, and I knew I wasn't going to put $10 million in investment. I didn't know how to go raise capital. I didn't know how to put a deal together. I didn't know how to analyze it. So the play or the thought was, man, I'm going to team up with an expert who knows these plays and, enter an amazing partnership with Devin, which is basically what we're looking for. We're looking for those other investors that want to go invest like this, can understand there's a lot of expertise needed. So we invest with, and then if you want to go learn, that's basically what we're trying to do here. So that utilities model was an amazing example. The debt terms also. So if you've never gotten a loan for $10 million on a commercial property and maybe don't have the net worth or don't have the, the experience, it's going to be a little harder for you to do that if you get it at all, especially today's time. But if you're partnering with an expert, then there is track record, there is experience. And that's part of that because, if I've never done a deal, but I was able to pull it together, it's a great property. My interest rate may be a few basis points higher, if not a whole basis point or half a basis point, whatever the percentage higher. If you partner with an expert, you're going to be able to create additional net operating income to your investment, which is why when Devin says at the beginning, and I said at the beginning, now why are we doing this? Man, we want to create that partnership opportunity to go do more of these deals. So anyways, sorry to pause you, but the utilities was a big one, the debt rate. So what's a contract service? What does that mean? Like, well, how do you decrease expenses there, Devin?
Just negotiating contracts. This isn't going to be a huge number, but you might have a trash service that you're using and you can get a better rate or trade vendors. You may have tree trimming service. You might be able to get a better rate. So you just want to look at all those contract services where you're bringing in a third party to perform some sort of deal. There's you might buy a plumbing auger for the property, which is an investment, but that'll prevent you from calling out the plumber every time, and that's a contract service that you can mitigate, right? So there's a lot of kind of little ways to improve your contract services expenses.
If you have a laundry
it's not going
room,
to change the. What's that?
If you have a laundry room, you don't Do you buy your appliances, or do you hire contract services for that, or depends on the property, I imagine, but that's a
Yeah,
contract.
depends on the property. I mean, a lot of these laundry specific are locked into these multi-year leases with CoinMock, and we won't get into that. But in general, we're inheriting a laundry contract. So there's some opportunity there, maybe not a ton, but it's worth a look. Economies of scale is something that we'll talk about here. This is as you grow and you have the ability to maybe share resources between properties. Maybe you're sharing maintenance or leasing resources. That will drive down the cost per property. This is typically once you get into kind of a multi-property situation, or if you're hiring a third-party management company that's able to split some resources among a couple of different properties, maybe one of theirs and one of yours, where they can drive some of that payroll cost down.
And real quick, I forgot to mention, if anybody has any questions, down at the bottom, there's a Q&A. I see a few of them starting to build up. So please enter your questions there if you do have any as we're going through this. So we'll take some time to answer at the end too.
Yeah, the next up here is tax protests. So you're going to want to hire an attorney every year or tax protest service to review your taxes, and if needed, to go in there and fight them every year, because you want to keep your taxes low. Taxes are the biggest line item. You know, sometimes it's number one, sometimes payroll is number one, but those are your two biggest line items. And you're going to want to do everything in your power to fight those, because if you can take your biggest line item and knock it down by 10%, you're really winning, you know. And at the property level, you know, you can make the argument that if you have a higher payroll, maybe you've got a higher quality staff. But if you're paying more in taxes, you're not seeing a direct correlation to better anything. You're just paying more, right? So you want to fight your taxes every year, and you might hire an attorney to do that. The last one here that we have for decreasing expenses is oversight and control. And so this is not necessarily meaning getting something cheaper. It just means that people are doing what they're saying, that money's getting spent where it should be getting spent, and that you're preventing waste and theft, right? And theft is kind of nefarious, and you hope not to have that on a property, but businesses are not immune to theft. But waste is maybe not nefarious, right? Maybe somebody just had an oversight or a long day, and that you know, you can review some payments and find all kind of errors and things that are wasteful, even if nobody had ill intentions. And so by keeping a tight oversight and control on your expenses, just like any business would, you can tighten that up and improve. Ultimately, the name of the game is improving your net operating income. So those are some high-level ways to decrease expenses. Again, you know, decreasing expenses or increasing income, they both have the same net effect on your net operating income.
That was a good run through, Devin. Man, we appreciate all the insight, the education, the knowledge. Man, I think we're about 43 minutes in, so plenty of time for Q&A. I see a few here. Let me read a few off so we can kind of go through these, and we'll go through maybe one of them. ROI. What does ROI stand for? Your return on your investment. So we had kind of mentioned, you know, if I put it in $1 in, we can turn it into 16. And what is that ROI, or what is the percentage? Another example was you know, if you had $1 million and your cap rate was 10%, then you're going to make $100K of NOI a year. So that's your net operating income. So your return on that $1 million investment would be 10%. So ROI. So let me mark that one. And then let me give you another one here. These are simple ones, so we'll knock these out. Will you email a presentation and a recording? Yes. If you are registered through apartmenteducators.com through the Zoom link, you should have put in your name, email address. We are going to try to keep in touch with everyone there as well. Some systematic monthly, you know, kind of updates where you can opt into that as well. So the recordings are on Apartment Educators websites. If you go register, you can see all of our past events. And then also the Apartment Educators has some 7 module free modules for learning. That's there also. So there's that question. Let me see. This one is if your mortgage payment is below the line, how does changing the debt terms affect your NOI? So, you know, Devin, I'll let you handle this one, my friend.
Yeah, so it doesn't. It's not going to change your NOI as much as it's going to change your cash flow. But your debt terms, we wanted to include in there as the overall expense for the property, because it could be huge, right? Going from an interest only period to an interest pay where you're paying down principal, that's going to have a big impact on your free cash flow, which is definitely different than NOI, and it's not going to impact the valuation, but it's going to impact your cash flow. And if you're sending investors checks, that's important. Great question, though.
And then next one, what kind of taxes can you fight? So Devin, you mentioned every year you're hiring an attorney to assist and literally protest or do whatever they need to do on their court side to fight for you. Anything else that you're doing along those lines?
No, it's just your county taxes, right? So if you live in, Bexar County where we live, you pay taxes on your house that you live in, right? If you have rental houses, you pay county taxes. If you own an apartment complex. So yeah, it's a tax protest. We use the word fight, but it's the same thing. It's every year going and protesting those taxes. Now, some years you don't. I mean, we had a property this year go down in value, and we're certainly not going to poke that bear, right? But in previous years, we've seen some really large year-over-year tax increases. We definitely want to protest those where applicable. So yeah, we need tax protests.
Right. And
we've got a question here to go over the $1 to 16 calculation. It simply means $1 of net operating income divided by a cap rate of 6%. 1 divided by 0.06 equals your valuation improvement, right? So $1 net operating income divided by a cap rate of 0.06 or 6% equals 16.66 repeating on a valuation. So net operating income divided by cap rate equals value. We got a question from Cherie here. How do you isolate the projected ROI? So it's basically the cost of anything, or the annual income of anything divided by the cost of that item. Some things you can isolate, some things you can't. If we're going to spend $20,000 on a new monument sign, we cannot isolate the ROI for that. We can't say, hey, we're going to spend 20 grand and we expect this rent improvement. So the exterior, the bigger items, those are tough, and it's difficult for investors. It's difficult for the bank to put a valuation on those kind of things because there's just not a direct correlation. But let's say you have valet trash. Well, let's say, it cost, the service cost $10 per resident, and you could charge 20. Well, you would just take the net. That's, in that simple example, you would take $10 and divide that by the cap rate right there, because that's your net increase, right? So you can get down to certain item specific ROI, and sometimes you can't isolate the ROI. An example of a private yard, hey, if it's going to make you 50 a month and it costs you 3,000 to put in, you can do an ROI calculation pretty quick on that. So if it's $50 a month times 12, that's $600, and it costs you 3,000 to put in, that's 20%. Okay, I might consider that. If it costs 7,000 to put in, I probably wouldn't do it because the ROI is not there. We've got a question here. If Texas is a non-disclosure state, how often are your taxes being reassessed? In Bexar County, where we are, every year they get reassessed, right? So that's just something that we're going to deal with on an annual basis. Good questions here. I think we're kind of wrapping up the session here. I think that's it for the open Q&A. Wanted to kind of talk about the next event that we have here coming up for you guys is June 17th. This is another noon meeting. This is how to buy a $10 million apartment complex. We're going to cover multifamily financing. It's really a great topic because we're talking about big dollars and big numbers here, but the mechanics of it actually kind of gets simple in a lot of ways, right? It's not something to be taken lightly, but when I made the transition from doing all these houses and investments to doing larger multifamily projects, I was kind of shocked and amazed at how simple some aspects of it got. So that'll be an exciting topic. You can register at apartmenteducators.com/events. And the topic will be how to buy a $10 million apartment building. That's on June 17th. So go and like us on Facebook. Go register for the next event. We thank you guys so much for coming out to the event today. And we can't wait to actually meet you out at one of our live events soon, shake hands, and continue our journey into multifamily investing. Thanks so much, guys. Have a great afternoon.
Bye, everyone. Thank you.